All right, let's dive right into this explainer. We're going to look at a legal framework born roughly 350 years ago, one designed to conquer the ultimate antagonist, the unpredictable, chaotic, and relentlessly unforgiving ocean. We're talking about the foundational principles of marine insurance. It's essentially this massive, cinematic clash between meticulous human contracts and the raw, unbridled power of nature. Just picture it for a second. A colossal cargo ship leaves port, pushing out into dark, churning waters. You've got millions of dollars, literally maybe an entire company's net worth, just riding on those waves. Now ask yourself, if your livelihood was stacked up in those steel containers and that ship started taking on water, how do you make sure you don't go down with it financially? I mean, you can't control the weather, right? But you absolutely can control the math. To actually survive the high seas, we need the ultimate financial safety net. At its core, insurance is just a system of taking an individual's massive potential losses and spreading them out over a much larger group of people using a common fund. But, and this is a really big but, the key word here is fortuitous. The ocean is harsh. Ships will rust, for sure. But marine insurance? It's strictly designed to cover sudden, unforeseen disasters. Think rogue waves or a sudden massive fire. It absolutely does not cover inevitable wear and tear or what the law calls inherent vice. It's there for the unexpected. Not the inevitable. So, before our ship even leaves the dock, we have to lay out the ground rules. Who is actually allowed to seek this kind of financial protection in the first place? Well, this brings us to a foundational concept called insurable interest. Now, at first glance, paying a premium to get a massive payout if a ship sinks kind of sounds like placing a bet at the racetrack, right? But here is the critical difference. A bookmaker places a totally random bet hoping to win money from a situation they have absolutely zero stake in. A cargo owner, on the other hand, well, they must suffer actual financial ruin if the peril happens. Otherwise, the contract is completely void. You literally have to have a financial interest in preserving that property at the exact time of the loss. If you don't own the cargo or bear legal responsibility for it when it goes down, you get nothing. It's not a casino, guys, it's a shield. Okay, so as the cargo gets loaded up and all that heavy paperwork is finally being signed, we need to talk about negotiating the contract itself. Because standard rules of commerce, they're completely thrown overboard here. Usually in business, we operate under caveat emptor, right? Let the buyer beware. But marine insurance demands something way stricter. It's a Latin concept, uber rima fide, which translates to utmost good faith. The absolute crucial point here is that the person buying the insurance must proactively lay every single card on the table. You have to disclose every material circumstance regarding the risk. Basically, anything that would influence a prudent insurer's decision on pricing the premium or whether to take the risk at all. If you hide a material fact, whether you do it fraudulently or even completely by accident, the insurer has the absolute right to render this entire survival contract totally void. So, no safety net for you. All right, the paperwork is signed. Now we actually set sail into a violent storm. And this is where we have to look at the anatomy of a disaster, because out there on the water, things get complicated fast. When disasters strike at sea, they don't just happen. They compound rapidly into this crazy legal puzzle. Let's imagine a cargo hold absolutely packed with valuable rice. Okay, step 1, rats somehow get on board. Step 2, those rats gnaw right through a pipe. Step 3, seawater floods in through that broken pipe. And step 4, the rice is totally ruined. Now, if your policy covers perils of the sea, but specifically excludes damage from vermin, do you get paid? To solve this, maritime law uses the principle of causa proxima, the proximate cause. We aren't just looking at the very last thing that happened, or the most remote thing either. We have to trace the active, efficient chain of events. In this classic scenario, the law actually dictates that the entry of the seawater, which is a peril of the sea, was the dominant proximate cause of the ruined rice, not the rats. Figuring out that proximate cause, that's literally the key to unlocking the vault. Okay, so the storm has finally passed. The damage is done. Now we have to figure out how to calculate the actual financial rescue. And to do that, we rely on the principle of indemnity. There's this 1883 ruling, Castilian versus Preston, which brings immense legal gravitas to this whole situation. It perfectly defines what indemnity really means. Listen to this. Insurance is strictly about exact financial compensation designed to put you back in the exact financial position you enjoyed right before the disaster struck. You shall be fully indemnified, but, and this is vital, you will never be more than fully indemnified. The law meticulously prevents anyone from trying to orchestrate a disaster just to make a quick profit. Remember, this is a system of restoration, definitely not a lottery ticket. But wait, there's more fine print to survival here. We really need to talk about the duties, the warranties, and the deductibles that the crew has to navigate. Because even when absolute chaos strikes, the legal framework demands strict discipline. In marine insurance, warranty is an absolute promise. You have expressed warranties, which are written right into the policy, like literally promising the ship will set sail by March 15th. Then you have implied warranties. These are woven right into the fabric of the law itself, like the absolute requirement that the ship must be completely seaworthy the very moment it leaves port. If you breach a warranty, the insurer can just completely walk away from your claim, even if that breach had literally nothing to do with the ship sinking. Plus, under what's called the duty of assured or sue and labor, when disaster hits, the crew is legally bound to fight that catastrophe and minimize the loss exactly as if they had no insurance at all. You can't just throw your hands up, grab a lifeboat, and say, let it sink, we're covered. And here's a pretty harsh mathematical reality. Even if you do everything perfectly right, your payout might still be a big, bold zero. That's the brutal nature of deductibles. A deductible is just that pre-agreed amount you have to pay out of your own pocket before the insurer ever steps in. So let's say you have a massive $10,000 deductible in your policy, and you suffer a punishing $9,000 disaster. Guess what? Your payout from the insurance company is zero. Absolutely nothing. Insurers use these to weed out the small, frequent claims, which actually significantly reduces the premium you have to pay up front. So it's kind of this calculated gamble you take on your own resilience. All right, so the storm finally settles, we actually reach port, but now we have the grim task of picking up the pieces and categorizing the absolute destruction left in the ocean's wake. In the legal world, there are essentially two types of total devastation. First up is actual total loss. This is that epic, visceral destruction. We're talking the ship is physically sitting at the bottom of the Mariana Trench, or maybe seawater flooded the hold and turned a massive cargo of powdered cement into a giant, useless block of solid rock. It has literally ceased to be the thing that was insured. But right below that, we have constructive total loss. Now, this is purely economic doom. The ship might be physically sitting right there in front of you, stranded on a reef, but the cost to tow it off and repair it, it would exceed the entire value of the ship itself. It's actually highly ironic when you think about it. An actual total loss is incredibly violent, but claiming a constructive total loss requires this surprisingly polite, bureaucratic act of filing a formal notice of abandonment just to hand the wreck over to the insurers. Finally, to keep this ultimate safety net intact, the system relies on two last legal concepts, subrogation and contribution. Think back to that rule we talked about earlier, that you absolutely cannot profit from indemnity. Well, to strictly enforce that, if an insurer actually pays out your massive claim, subrogation kicks in. This means they immediately take over your legal rights to hunt down whoever caused the crash and sue them to recoup their costs. They basically step right into your shoes. And what if you thought you were being clever and bought policies from 3 different insurers for the exact same cargo? That's where contribution comes in. They will all just split the bill proportionally. At the end of the day, you still only get exactly what you lost, not a single penny more. So as we look back at the meticulous design of this centuries-old maritime law, from the absolute necessity of utmost good faith to the really strict calculations of indemnity and proximate cause, it's incredibly clear that navigating risk is just as much about precise language as it is about sturdy steel. Look, you can never truly control the sheer chaotic wrath of the sea. But ask yourself this, looking at your own ventures, your own businesses, are you actually disclosing every material fact? Do you know your proximate causes from your remote ones? Is the legal and financial framework protecting your livelihood truly watertight? Keep exploring, keep questioning, and whatever you do, make sure your safety net is ready before the storm hits.